Good day, everyone. This is Tom Hulick. Let's get started.
Great, Tom. Thanks. And welcome, everybody, to our Strategy Asset Managers mid-year market call. We're grateful that you could join us. As Tom said, I hope you're all managing the heat, enjoying your summers. I'm Greg Wirtz, and I'm a director with Strategy Asset Managers located in our Westport, Connecticut office. Holding the fort down on that end, as well as Kerry Longson, who is in New Jersey, and Rick Kincaid, our partner down in Florida. I just wanted to remind you all that along with investment management, we do full wealth, estate, and financial planning. And that's something we stressed at the beginning of the call for those who are not advisors on the call, who have their own clients, obviously, but for our clients. So should that be something you'd like to do, please just reach out to your representative and schedule a call. So today's call, we will have Tom Hulick, our CEO, who will be the moderator, as well as Joe Traba and Alex Hagstrom, who are our two senior portfolio managers, to discuss their outlook, key issues, address any concerns, questions you may have. There'll be a Q&A at the end of the call. I would please ask that you keep yourselves muted during the call. There is a little chat box on the bottom of your screen should you want to put in a little note to one of the people during the call to ask, or just wait to the end and pop off and have at it with Q&A. Any rate, with that said, let me hand the call over to our CEO, Tom Hulick.
Thank you very much, Greg, and welcome to all to our mid-year update. We have a lot to go over. Strategy Asset Managers has been managing money for clients for over 20 years now, and we're very pleased that we have relationships with 25 separate investment firms using the Strategy Asset Manager portfolios in our Dividend Plus portfolio, Worldwide Equity, our growth, and our quantitative portfolio. And we are here to serve you because you deserve the best advice that's out there. Today, we find ourselves asking the questions that our clients have asked us for the last 6 months. Why did the stock market rally from its lows in October to where we are today? What are the key economic indicators telling us? What are the major risks ahead? Are we at the beginning of a new bull market? That what if scenario, and you'll hear about that. And then we always like to refocus on what our job is in serving you and what you deserve. So I'm going to introduce Joe Traba, our senior portfolio manager, and Alex Hagstrom, and we are now going to get into the what if scenario. Joe?
Thank you, Tom. And again, appreciate everyone being on the call. And before we start, it's just what a remarkable turnaround from 8 months ago. And before we look forward, I always like to look backwards. And one of the things that we did say last year, it didn't look as bad as feared. And obviously looks what happened this year. Now, there is one big question mark, and that is really with market breadth. But we are starting to see an improvement there. And what does that mean? That means this year, the market's rally, when we look at the S&P 500, is really led by 7 big technology companies. Now, these 7 big companies obviously were down considerably last year, and they've led the rebound so far. And as we've seen this narrow leadership, meaning just a few stocks participating, what's encouraging is that we have started to see other stocks start to outperform. And that's important for a healthy market. And when you look at the different cycles in a market. So that is encouraging, and we look for that to continue. Now, that doesn't mean technology will go down. It just means you're getting a little bit of a catch-up of some of the sectors that didn't perform so far this year. And that's one big area that we want to mention. And again, we'll go over some of the recession fears. Perhaps they were a little overblown. And, like we said, we didn't see any change in policy. And that's also factors into what's happened with the market. So why did the stock market rally? And we always say this, the markets are forward looking. It's looking ahead. And when we look at earnings, we know the last 2 quarters with corporate earnings were negative year over year. But what are we seeing? It's this reporting period that earnings are looking that they're going to be higher and beat expectations. So it's early, but that's what we're seeing so far. And we also look at what are some of the big fears that we had last year. It was interest rates going higher and inflation. We all remember inflation just going up and up and up and up. Well, we'll go into a little bit now what we're seeing. And again, the big one was recession. Everyone seeing, when you looked at the media headlines, everyone calling for a recession. Not, if we'll have one, it's when. And one of the things that we focused in on was employment. And that's a big picture when we look at the engine of the U.S. economy. We did see a lot of the headline news with a lot of the large tech companies laying off thousands of people, but wasn't captured in those same headlines was the service side. And this, you really have to think about restaurants, hotels, live events, sporting events, and travel. And those areas on the service side have just gone straight up. We've also seen a really big uptick in what we call employment with the service side, but also with manufacturing. And that has to do with a couple of different areas. But that's another big positive for the United States is manufacturing coming back to the U.S. And it's a little bit more in the middle America. But again, that's another big positive.
Alex, we've seen a big dislocation with the data that comes from the government and how we are shifting our clients into sectors that have benefited. And would you please go into some of the economic analysis for us?
Yeah, absolutely. And I think the biggest unheralded story of 2023 has been just a massive, unprecedented surge in manufacturing construction here in the US. And with COVID, the war in Ukraine, all the issues in China, firms are realizing that they need to bring their supply chains back on shore. They need to bring their manufacturing back to the US. And this trend is potentially going to continue for years, if not decades, especially now that it's going to be enhanced by these tremendous advances in robotics and AI. And, these technologies, they're going to help make the US one of the best, most desirable countries in the world to manufacture in, especially high-tech manufacturing. And, it's no secret to any of us that America's lost a lot of manufacturing jobs over the past few decades. It's going to be just tremendously beneficial and a tailwind, for years and years as those jobs start to return. Now, sort of jumping over to inflation, which Joe did mention as well, we saw a tremendously encouraging inflation number last week with the year-over-year rate falling to 3% for the first time in years. It's now fallen for 12 months in a row, down all the way from 9% in June of last year. And that's been, one of the most rapid, consistent declines in the rate of inflation in U.S. history. And a lot of market participants that had thought a soft landing was just impossible, a lot of people thought inflation could never decline, they're being forced to reevaluate those positions. And a lot of those people invested, got their money out of the stock market, and now they're having to come back in as a soft landing becomes more possible as inflation does decline. And when I reference a soft landing, I do mean a fall in inflation down to the 2% target without a recession. And again, a lot of people, this was not us, thought that this could never happen. But at this point, we are, extremely close to that 2% target. And with that, there is no indication that we are in recession or even any indication that a recession is imminent. The labor market is tremendously strong right now. Wage growth is strong. Consumer spending is strong. That being said, this strong, wage growth does make it possible that inflation stays resilient around this 3 to 4% level, and that, rates will have to stay high for a bit longer potentially.
So, Alex, the media and Joe, the media has been focusing on recession as you've just been talking about. But even that type of dislocation between whether we're in one or not, or when are we going to reach that, we really have to guide our clients in specific areas and what sectors are going to be important. And we've seen a massive shift into fixed income because of rates, and we've also seen a change in the direction of the stock market. What are the money flows telling us right now?
Yeah, that's important, because one of the things we always talk about, if all of us buy one stock, when you get an institution coming in there and they're buying millions of stock, it makes a big difference. So when we looked at the money flows, and this is just how people are positioned in institutions, and we had continued to see money flow into fixed income. And it wasn't until recently where we're starting to see some of that money, again, flowing back into equities. So this leaves the opportunity, as people have been locked in either with interest rates higher, going into cash or going into bonds on short-term basis, that money to come back into the stock market. And that can be a tailwind for the second half of the year.
Alex?
Yeah, also I think, in the initial stages of this AI boom, people are extremely focused on technology, and they're not focusing maybe as much as they should on companies outside of the tech sector that are going to benefit in massive ways from this. Specifically in the industrial sector, when you imagine the potential for a fully automated robotic factory, run by AI, just how profitable that could be and how much of a revolution that's going to be for companies which are not not classified in the technology sector.
Right. So we're witnessing a slow rotation or broadening of the equity markets right now, and our portfolios usually get compared against the S&P 500 broadly. But if you look at us in comparison to other dividend and value managers, we're significantly outperforming the indices on that side of things. There is a great difference between growth and value this year. The next question is when are we going to see a rotation into other areas of the market, Joe?
Yeah, and that's a great question. Again, I always like to look back last year. If you had owned those stocks, you would be down, over 30 to 50%. And obviously, when you get a new rally, the things that are most beaten down, that's usually the first part to rally. Then what's encouraging when you have a longer bull market is you start to see other parts of the market, starting to participate. So in the first quarter, it was, you had over half the stocks in the S&P 500 that were negative. And again, that's narrow breadth. It's a technical term. It just means not a lot of stocks going up. And what we've seen recently is, again, like Alex alluded to, there are other parts of the market that are going to start participating. And it really comes down to, for us, it's supply, demand, and earnings. Companies are going to better utilize technology. And when we look at industrials, their profit margins are going to get better. We all know when we go to the store, it's rare that we see prices go lower. And what happens is those companies, are making a better margin. That margin is growing for them as their fixed costs remain stable. And again, they have pricing power. And that's when you look at the length of a normal economic cycle, that's when you start to see other sectors do well. And another one that was interesting is healthcare. Now, healthcare did very well last year, and this year's been pretty much not participating in the markets at all. And what are we seeing is we are going to see people going back to the hospital. Think of how many people put off going to the hospital because it just was too much of a pain. And that is reoccurring now. But we also think of the science and development on the research side with new technology and potentially new cures, so, and then also getting into a little bit of behavioral science, that's more mental health. These are areas that are going to boom going forward. Mm-hmm. So again, those are two areas that we do like as well.
Alex, do you have any comment on that as well?
Yeah. So, while in the short term, sentiment causes these massive fluctuations, over the long term, and this is what we focus on, profits are what matters. And as you see, and as the market sees how profitable a lot of these companies are and how profitable they are going to become once they start to truly leverage these new innovations, you'll definitely see investors start to shift more in that direction.
Well, we're definitely seeing a shift in sentiment across the board, and if you've been following the equity markets, to stay on point there are 8 stocks that have represented a majority of the gain in the S&P 500 this year, and it's Apple, Microsoft, Amazon, Nvidia, Google, Alphabet, Facebook or Meta, and Tesla. But as we see this shift in sentiment, and the market has appreciated significantly since late last year, our guidance to clients is to stay focused on the higher quality companies that are benefiting from strong balance sheets and cash flows. I'd like to talk about that, Joe, a little bit, and why we believe, again, that it's going to be a broadening across the board, and we're starting to see that now.
Yeah, and it's interesting. One of the parts of our research when we look at companies is obviously their cash flows. And a lot of these large cap tech companies have tremendous cash flow. And that, for us, that gives you some guidance as the roughs, you kind of look at the ocean and the waves going forward, which companies can withstand, through the length of the cycle. And it really gets down to their debt as well. As interest rates have gone up, companies that were highly leveraged obviously have to pay more for that debt and actually to service it. And you can kind of think of it as a consumer that's using their credit cards to finance their lifestyle. It went from, potentially high single digits to, you're looking at over 25 to 28%. That's a massive increase when you look at your books. And that's one of the things that we're looking at is, again, bankruptcies, which we haven't touched yet, but I think this is important. And Alex will go into detail on this, but it's really part of a normal cycle. Companies in the U.S., they should be allowed to make as much money as they can, but also when they're not working, they should not be supported by the U.S. economy or by some of these free passes that we've had during COVID. So we have seen bankruptcies uptick. We have seen bank failures. And the big thing with the bank failures, it did not lead into, when we look at the health of the financial sector, we didn't see disruptions. And what I mean by that, we look at the spreads when you're selling things, there was liquidity, and that never was a factor, which we saw in 2008. So it's a lot of things that are very different from what we've seen in the past. And that's where we try not to get caught up in the headlines, but actually look at our research and what are the facts. Alex, did you want to share a little bit about bankruptcy?
Yeah, and I think that large increase in bankruptcies, that should not come as a surprise, just given how rapid and how drastic the spike in interest rates has been. And we're going to continue to see over-leveraged, poorly managed, weaker companies go bankrupt in the back half of the year. However, our portfolios are stress tested against these sorts of environments. We strive to own, the most stable, well-managed, low-leverage companies. These are companies that have survived multiple rate hike cycles, multiple recessions. And while nobody wants to see bankruptcies, it's very important to understand that they are a necessary and critical part of capitalism. And the reason capitalism works and works so much better than any other system is because it allows resources to be allocated efficiently to their best possible use, not wasted. And in order for that to happen, companies with bad management, bad business models, they need to go bankrupt. They need to go out of business so that their resources can then be reallocated to a more efficient use. And we saw this with First Republic's assets going to JP Morgan. And when companies are not allowed to go bankrupt due to government intervention, then resources continue to be wasted. And in the long run, economic growth stagnates. And that's exactly what we're seeing today in China and Europe, where the governments have been propping up bad companies for years. And now, those countries have youth unemployment rates above 20%. They're just stagnant economies. So in order for us to continue to have a vibrant economy, we need bankruptcies over the long run. In addition to that, bankruptcies are also tremendous opportunities for well-managed companies with cash on hand. Again, like the companies we own, because it allows them to buy assets from these bankrupt companies at extremely discounted prices. And that sets them up to be extremely profitable for years to come. And we've seen that, whenever there has been a wave of bankruptcies.
You talked a little bit about China and why the U.S. is not like China. Joe and Alex, let's discuss that.
Yeah, I mean, first off, it's two different, entirely two different systems. And one of the issues we've had with looking at China, it's hard to find out what does you really own. And the transparency of the United States is unparalleled to China in particular. And that's, for us, that's key. That's everything. If you can't believe what someone owns and who's actually owning it, it's hard to see where the risks are. And again, how are they going to shift? And what I mean by that is, what is a true entity as opposed to being government sponsored or government backed? And that's a hard part for us to analyze when you get into that gray area.
Yeah. We don't need to focus a lot on it, but go ahead, Alex.
We're blessed and we take it for granted that in America, if someone does you wrong, you can sue them. If someone gives you a financial statement, that's, true, accurate information. And that just doesn't exist in China.
Yeah. Let's go back and talk about the bank failures and also the commercial real estate trouble ahead, because it stresses the system out. And it is a topic that people are talking about. Joe, Alex, let's talk briefly on that.
Yeah, this is this year's gone so fast. There's so many,
and how that's going to impact any of the portfolio too. That tie it into that.
It's just been a remarkable year, and we're barely in July. But if you remember back in the beginning of the year, this was a major topic with a lot of these regional banks and the stress testing that was going on. And what do these portfolios own? And when you look at their board of directors, when you have a lot of people that aren't in the banking sector, that's kind of a red flag. And one of the areas that we didn't own any of these regional banks, and we still don't. It's again, doing that research and knowing what you own. One of the big issues was, again, what these banks owned and how it related to their debt. And that, is something that you had to be aware of. And when you get a run on a bank, it's really hard that means everyone wants their cash now. The way banks are situated is they obviously lend off of their deposits. So when you get a couple days where you have close to 30% of your assets or even more being called, the bank doesn't have that time to get those deposits. So that's what we saw. But what was interesting, and from my perspective, looking back in 2008, you didn't see a big change in the banking health, meaning the health of the banking sector continued to remain resilient. That means that there was liquidity. When you wanted to sell something, the spread, meaning the price between the buy and the sell price, was minimal. And when we saw this in 2008, it was huge fluctuations. So the banking sector and the health of the banking sector was fine. And I think that really had to, when we look at these are the mega cap banks like the JP Morgans, this actually did a favor for them. As Alec mentioned, they were able to buy assets off these regional banks for, pennies on the dollar, and they got a government guarantee. That's a pretty good, price to pay.
Yeah, and specifically with commercial real estate, just the way the United States is set up, I think approximately 70 to 80% of commercial real estate lending does come from small banks. Large banks haven't really been focusing on that sector for years. So the ripple effect is going to be mainly in small banks. And yeah, a lot of office real estate needs to fall in value. And the investors that own that will suffer. However, like I was talking about earlier, vibrant capitalist economy. They'll sell those buildings. Those buildings will be renovated. Perhaps they'll become apartments. And those assets will be reallocated to something more efficient. And in the long run, it'll be okay.
Yeah, I don't. The commercial market is really, really interesting to think about. If you look at all the major metropolitan areas in the United States, and you can pick anybody in particular, let's say New York or LA or Chicago, and you have these large buildings who are losing tenants. But where are those tenants going? Are they really going home, or are they redistributing out to the smaller suburban areas, which I think is the case? And yeah, there are people working from home more these days, but the smaller banks can't finance those large 50-story buildings. Those are insurance companies, private equity firms, sovereign debt. It's just something to think about, that what if scenario on that side for us. Any comments?
Yeah, just, a quick note on that. It's the banks don't want to be real estate. They don't want to own it.
Correct.
And what we've seen in LA in particular is a couple of big buildings. They didn't foreclose on them, was the key word, but the banks, are looking to renegotiate. And as we've mentioned before, you kind of think of the multi-purpose of a building. And what does that do? That brings in more spending for construction, because you're going from a big office to potentially, if you're going into, renting these units for residential, that's a boon for residential. And those areas that are heavily with the homeless population, potentially that gives an out for construction for low income. So you do open up the gamut to, again, construction, and that is a positive longer term if you get multi-purposing.
Alex, any comment?
Yeah, I would also say that a lot of the problems are sort of specific to these cities. There's like New York City and Los Angeles, have problems even beyond COVID that they need to sort out. That being said, if they were to sort out those problems, things could certainly get better for those places.
Yeah, we don't have a flux of people coming from Texas into our tax system into Los Angeles and California. It's vice versa. So that's a voter issue down the road. That was kind of tongue in cheek. We should start talking about what would it take for this to be the what if scenario, for this to start our new bull market, which we've been talking about for over 6 months. My father, who passed away in November, and I were talking about this over the last year as we saw the development of AI, artificial intelligence, and technology continuing to move forward and not look back. And the what if scenario is, what if we're going to see the next greatest movement and technological revolution out there? And I think we are. And we're positioning your portfolios for that right now. Joe?
Yeah, and that's an important point. What we're trying to convey is technology is really home in the United States. All of these tech companies are United States. They're headquartered here. They were started here. That's a big, big, big plus for the United States. And when we look at other indices, they don't have that tech as a sector. Or, some of these tech companies are larger than the economies of different countries. That's how large they are. And when you look at that kind of scale, as they continue to grow internationally, that's a big presence, but it really does help us. And obviously our taxes, like Tom mentioned too. When we do look overseas, Europe, again, has a very sluggish GDP growth. We do know that the Eurozone was technically in a recession. And what are we seeing signs of them getting out of this? It's, again, we kind of think the U.S., this is no surprise. We usually try different things and we then see the rest of the markets catching up. And that's exactly what we've seen with interest rates. And I think policy is the next area that we'll see. And then again, that spurs growth, that spurs innovation. It encourages innovation, which is the lifeline in the United States and how these companies came to be.
Alex?
Yeah, and I think the U.S. reindustrializing, if you go back, decades ago, the U.S. was probably the top manufacturing country in the world. That went away for the last few decades, but I think as that comes back, and that is something that should come back and can come back. We have the technology, the human capital, the rule of law. You really have everything for all of these supply chains to come back, now enabled by robotics and AI, and to become the manufacturing capital of the world again.
Yeah, there's been a lot of talk about infrastructure spending and an aging infrastructure that's out there. How do our portfolios benefit from that, Joe?
Yeah, well, directly it's spending, number one, and then again, it's usually utilities when you look at. So when you're upgrading an aged infrastructure, and we've seen that here in LA, a number of pipelines and obviously cables and those such just haven't been touched in decades, that does get upgraded. And when it gets upgraded to now. And we obviously know technology goes in one direction, that's forward. So it's beneficial. And yes, you can see a build out of new technology as it relates to not just electricity or power. I want to be very with how we source energy to power up our grid. That is an area that's just going to continue to boom. And again, it's with efficiencies of scale, that's beneficial, for that area. And I do think, that's what you're seeing with some of the emerging markets that didn't have the infrastructure. It was actually bypassed. And kind of think of India and also South America, Latin America. Those are areas that can benefit pretty quickly.
Alex?
Yeah, I mean, there's a, as you mentioned, a tremendous accumulated underinvestment in the United States, specifically in infrastructure. And we do have very, very specific investments. If anybody wants to speak to us further after the call about them, that do take advantage of that. And this, like reindustrialization, this is, a multi-year, if not multi-decade trend, just, with respect to how much infrastructure needs to be built out, not just on clean energy, but also 5G, right? The fiber optic data networks, really all across the board, airports, roads, just a lot of opportunity to invest capital at very nice rates of return as we get this stuff built out.
Before we go to where we're going to go from here, I do want to just mention the advantage that you have as a fixed income investor with rates. And Joe, do you want to just touch on that briefly?
Yeah, and again, it's been so fast the move, but you can get short-term treasuries above 5.3%. And we look back again, less than a year ago, 8 months ago, you getting nothing. And even as recently, some of checking accounts and your savings accounts, they just are starting to pay that back. So it's still very attractive to get money market rates and short-term treasuries, corporate rates that are well above 5%. And I think what's interesting when you look at how long you can get that 5%, and that's when we look at a yield curve, it's very different when we look at this in 1 year. So when we look at the end of 2024, interest rates, when we look at the yield curve and the futures market, are telling us it's going to be down, or rates will be lower by 1%, by more than 1%. So that's just something right now that's very attractive, but I think it's worth knowing when that yield curve really starts to go lower.
Yeah, and that is something that, rates are not likely to remain at these super high levels for years and years and years, simply because, the interest expense on the debt alone is now going to exceed the defense budget. So just, given the magnitude of the government debt, that 5% rate opportunity, is not something that is likely to last, for years and years and years.
What should we be doing now, Joe?
And this is a big topic as we're always looking forward. We're obviously aware of what's happened, but I do think, again, the tremendous boom in AI and how this affects other companies. And more importantly, how does it affect us? And that's what we look at. And again, when we see this infrastructure building for manufacturing in the United States, that has such a big positive effect. And think about that. You now have a plant in middle America these are higher paying jobs than what they were before. But it's also going to help the hotel industry, the restaurant industry, that has these other areas that have a tendency to do well when you have these type of jobs coming in. And I think that's the next stage that we have to look at is the health of this market. And from the boom that we're seeing with technology, and again, we're not ones that think this is just going to end. We know from COVID, and we said this before, COVID acts, or these type of events, they act as an accelerator to change. And I just simply look at all of us on a call now. Doing a Zoom call is pretty much like picking up the phone now. And I think these technological advancements will continue, and we'll have new, exciting things to talk about as the years progress. And that's exciting.
Alex, any comment on that?
Yeah. I mean, look, whenever you get a drastic change like this, there's always people that are, afraid and say everyone's going to lose their job. And you could go back to, when agriculture was automated and, naysayers were afraid, there's no jobs. No one will be able to farm anymore. But ultimately what happens is every innovation like this makes people more productive. It makes civilization more productive. It makes society better, the economy larger, and our lives better. And, that's what you can expect to continue to see.
I was going to throw just a point out about, since we were talking about agriculture and the shift in the industry. I was up with a client in Bakersfield, and we were talking 2 days ago about the decrease in acreage for farming, and in particular for certain ag products, and significant decrease in acreage for I would say grapes in particular, and an increase in almond trees, and this rotation for going to the higher priced commodity for farmers is very important. Land is shifted in California from ag to industrial. You're seeing up in the Central Valley of California a lot of real estate being converted from farming into industrial and also residential communities, which we don't have enough houses for the amount of people that are looking for them right now. And that's why the residential real estate industry has maintained its resiliency across the board, and we haven't seen dramatic shifts down. But this rotation that we're seeing in the United States in the resiliency of the U.S. economy, it really does mystify a lot of the critics. And there are a lot of people that are looking to take down the actual progress that's taking place from technology innovation and consumer spending being strong. Joe, you want to say something? I can tell.
Yeah, and it's again looking back at COVID. And for me, it's pretty simple. When you do pure economics with higher interest rates, going from a certain starting point, it has a tendency to obviously lower productivity. And that's when you get these recession calls. But we have to remember, we were coming off of COVID, and think of how much stimulant was given. And I think that's where that starting point, when you talk about a recession, we were at a much higher level, and how I equate that is just a household that wasn't spending on travel, was staying at home watching TV. Their savings accounts went up. They were still employed. They got government assistance, but their spending wasn't there. While you fast forward a couple of years, they're still, have a reserve, and they're still spending that. And I think that's where we're kind of at now. And it's just how much longer will these higher rates kind of overlap with this excess in savings?
Alex, any comment?
I mean, yeah, look, there's obviously, eventually there's always, going to be a recession. So the people who call for a recession every year for 10 years, they say, I told you so. But, ultimately, the trend of our country and our civilization is up. But, it's been up. I know I always say it's been up for like 200 to 300 years. And, there's no reason to think that the next, century or decade or years will be any different. If anything, it could be even better, as, the advances today are, perhaps transformative in a way that we've never seen. I think, especially on the robotics side. You mentioned like shortage of housing in California. Imagine, what happens when robots can build houses and, AIs can tell robots to build houses, right? These sorts of problems, they eventually do get solved thanks to technological advance.
I'm going to go back and summarize the call and then go into our close. But we know that the market has rallied from the lows in October. The S&P 500 is up nearly 20% year to date. The NASDAQ is up 36%. The dividend index, the value dividend index, is down 1.7%. Our growth portfolio is up 30%. Our dividend portfolio is up 8%. So there's significant outperformance against the dividend index. Obviously underperformance on the S&P 500, but it's you want to compare apples to apples on that. We know that the market leadership is narrowed, but we are going to see more stocks participate in the second half of the year. The recession fears we feel are overblown, and maybe we are seeing a soft landing out there. The pros that we talked about, that Joe mentioned and Alex mentioned, strong employment and an unprecedented surge of manufacturing investment into the U.S., that's a positive. But the negatives, as you know, the banks collapsing, real estate vacancies, bankruptcies, credit card write-offs, that's a lot of stress that, as with anything, when you try to digest that, it can cause an incredible indigestion and disruption, although I think it's going to be temporary. So don't get caught up with the hyperbole you hear in the media and get emotional about it. You cannot slow technology down. It continues to move forward. Just in closing, it's important to remember that we're here to guide you through any tough time, and our strategies are designed to perform over full market cycles. And if we see risks ahead of us and what is going to slow us down, it could be lower earnings, a slowing economy, which we're already in, uncertainty surrounding interest rates and inflation. But we just outlined the reasons to be positive about interest rates and inflation. We expect corporate earnings to beat estimates and the Federal Reserve to end its tightening cycle soon. And it is possible that we are entering or have entered into the next bull market with the light at the end of the tunnel. So thank you for letting us lead you through all the turmoil in the last year and for listening to the optimistic outlook that we have. If you have any questions, you're welcome to go off of mute and or go into the chat below, and we will be happy to answer questions.
And you can also just email us as well.
That's right. And sometimes on your cell phone, if you hit *6, that will take you off of mute. We are available via email, and also you can call us. We're happy to answer questions for you. And also, please remember to reach out to your advisor, who you are talking to is guiding you along, and do your mid-year update. Get a review and process, make sure everything is current and you are in good shape. If you have any questions, feel free to contact Joe, myself, Alex, or anybody on the team, as well as your financial advisor. And I don't see any questions. I want to thank everybody for joining us, and we'll be back with another update in the fall. And stay tuned for an optimistic second half of the year. Thank you very much.